So in general, we do see that across the planet, countries are trying to devalue the local currencies. So this has this would impact the market in a couple of ways, I believe. One is we would see more investment in gold to protect the real value of money. The second thing is within emerging economies. So yes, in general, we see an increased growth in GDP of these countries. So, we see more money being converted into these local currencies. As a result, the export of these countries could be hampered as the local currency strengthens. So yes, we do see, we're still bullish on emerging markets, but we shouldn't forget the event risk in case the local yields would be reduced. And the third theme that we see still problems within the Euroland. So we do envisage volatility across the euro crosses. And in the US, we see that increased interest rate yields, hence again potential weakening of the dollar and the euro against most of the emerging markets. Interestingly, after post the subprime crisis, the immediate knee-jerk reaction of the market was back to vanilla. Vanilla, more liquid, and tighter spreads. However, we find that more and more market participants actually tend to use more intelligently, we would say, exotic products, and specifically, we would like to mention the correlation products. So we know that the markets these days are much more correlated across different asset classes. So which means that if one market moves, we can see the impact in other markets as well. However, at the same time, we see that one could use correlation products to hedge or to mitigate risk in an intelligent, cheaper way. And we can illustrate that by, for instance, investment in emerging markets. So let's say we have a bullish view on the BRIC currencies, right? So Brazil, Russia, India, and China. So one could put, and let's assume that one wants to put an investment using the foreign exchange market. So using a basket option would be a cheaper way to invest in such a market as opposed to using more traditional structures as vanilla options or cash trading. This is a very interesting question. In short, my answer is yes. Very interestingly, we see that the FX market is following the footsteps of the equities market. And actually, we see that in a couple of aspects. One of them is the increased electronic trading of FX products, as seen in different ECNs. We see that this has started with introduction of trading tools for the spot market, and now the market is ready for the next phase, which is electronic trading of vanilla products. So this is one thing. The second thing that we see about where the FX market is following the equities market is the introduction of algo trading, which just keeps increasing. We see that the introduction of ECNs also has increased the share of the retail market within the FX market. And a completely different angle is the usage of correlation products within the FX market space. So we see that as in correlation swaps, we see that in the increased usage of basket options, and we see that in the usage of what we call cross-asset barriers, as well as increased usage of quanto options. So I actually let's analyze. You know what? Let's analyze the current the drivers we anticipate for the coming year. So we can name a few. The first thing is the uncertainty in the Euroland, especially in the periphery of Europe, and it seems that the problem is still there. Therefore, we envisage higher implied volatility in the euro crosses. That's one segment of the market. The second segment of the market we'd like to mention is the States. So in America, we see that the back-end yields increasing, therefore potential higher volatility, and personally feeling that we anticipate weakening of the US dollar against non-euro crosses. And we'll explain why, because the third driver is emerging economies, where we still see good growth in GDP, which would probably entail more FDIs directed towards these countries. But we mustn't forget the event risk, which could also keep, if you like, volatility on its toes. So we could definitely see some crisis or meltdowns in specific economies. Therefore, there we also envisage higher implied volatility. Two other interesting things worth mentioning. One is that the long-term implied volatility, as in 10, 15 years, for instance, in dollar yen, is still trending at very high levels historically. So we do think this uncertainty is here to stay. And the last thing I'd like to mention is gold as a way to keep to maintain the value of an investment, as we see that there is a drive across the planet to devalue local currencies. So to answer your question in short, yes, we do think that the higher implied volatility is here to stay, at least for the coming year. So the tools in the FX market are actually there already. The thing is increased usage of sophisticated exotic options to reduce hedging costs. So we definitely envisage usage of such products to benefit for or to hedge against higher volatility. Yes. Indeed, the volatility of the underlying asset increases. It means that my chances of hitting my payout are increased. So let's say I purchase a one-touch option, and eventually the volatility of the underlying asset is increased. The likelihood of me getting my payout is higher. So this is a way to benefit as an investor from a higher actual volatility. Actually, 2010 has been a year where we've seen a massive growth in deposit structures, and the main driver for that was the reduced or the low interest rate yields. And actually, higher volatility would entail a higher return for an investor by selling options. And we as a company, we have invested heavily this year in deposit structures, and so far the feedbacks have been really good about that.